Welcome to GRE. I'm your host, Keith Weinhold. Rich Dad tax advisor Tom Wheelwright returns with me today with some really juicy topics. Do Joe Biden and his administration have a real chance of raising income taxes, raising capital gains tax rates, and cutting the 1031 exchange? Then we're going to discuss how to contest your property taxes, how you can receive tax breaks from involving your children in your business, and why the chances of you being audited by the IRS are higher this year than they were previously, today on Get Rich Education. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Winnebago, Illinois to Winnemucca, Nevada, and across 188 nations worldwide, you're tuned into one of America's most listened to shows on real estate investing, real estate economics, and wealth mindset. This is Get Rich Education. My name is Keith Weinhold. You probably know all that by now, but we do have new listeners every week. This is episode 354. Tom Wheelwright is figuratively waiting in the wings here. He's the tax expert. We're going to talk more about Biden tax changes that could be coming. You might even hear the phrase horrible policy once or twice in our dialogue, so prepare yourself for that. It's also about how you can actionably position your financial life to weather some likely tax increases that are coming. But first, rents are almost skyrocketing. Now, back in 2019, rents were essentially flat nationally. In 2020, the pandemic breakout year, rent growth was only around 1%, even as the home sales market was completely on fire. Now, just June over June, so June over last year to June of this year, rents are up 6.5%. That's just to the midpoint of this year. Now, of course, you can slice that a lot of different ways, like geographically, and whether it's a rental, single-family home, or apartment, or condo, and whether it's higher end or lower end. But even pandemic losers like New York City and San Francisco are seeing rent increases again. They're seeing occupancy increase again. A lot of submarkets in the Dallas-Fort Worth Metroplex are seeing 10% year-over-year rent increases. Let's look at a few more GRE cities. Memphis with a 7.6% increase in rent amount. This is year over year through June per Zumper. Jacksonville up 10%. Orlando up 8%. Tampa spiked 6%. Cincinnati up almost 6%. Chattanooga with a 10% year over year raise in rents. Des Moines up nearly 9%. A bunch of GRE cities in there, like you'll find at greturnkey.com. That's where the properties for those markets are. And again, this is not price growth. We're talking about year-over-year growth in rents here. As I've explained before, this all follows a larger predictable cycle. When housing prices run up first, rent prices often soon follow, and that's no different this time. And the reason that this happens is because when home prices run up, new home buyers will get priced out, and when they're priced out, they have to rent. Low interest rates, they don't help wannabe home buyers very much because those home buyers still need to meet that ever higher bar of having to make a higher down payment. A higher house price means that now your lump sum down payment amount is going to have to be higher, and when wannabe buyers can't keep stretching higher on a down payment basis, well then what happens? They become your renter, or they have to stay put as your renter. That's your tenant. That's your renewed, rejuvenated rental demand right there. And gosh, that is what is so beautiful about investment property. When you're paid 5 ways, you can play so many sides of this. And then when you're concurrently benefiting from the inflation triple crown, you're profiting too, all while inflation makes most people poor. Inflation is now coming in hotter than Death Valley in mid-July. Just last week, the CPI was reported at a blistering 5.4% year over year. That is the highest inflation rate in 13 years now. Basically, that's the number that the government admits to because that's a government number. In reality, many think it's higher than that. So the CPI, despite being a faulty metric like so many government stats are, it basically measures the change in cost for consumers to buy stuff. As you know, the PPI, the Producer Price Index, measures the change in how much it costs producers to make stuff. Well, since stuff gets made before stuff gets bought, then the Producer Price Index, that can be a bellwether for what's going to happen to the CPI in future months down the road. So it can forecast this future consumer inflation. Well, the PPI, that number also came in last week, checking in hotter than the surface of the sun at, are you ready for this? 7.3%. Yes, a 7.3% increase for the 12 months ended in June. Gosh, more than any time in the history of this show, a dollar is like an ice cube melting in your hand, and it's melting faster than before. But in fact, if you're following my total, wealth plan here, the dollar is melting in your money-saving friend's hand faster than before, or your equity-storing friend's wealth is melting better than before, while you're benefiting from that inflation triple crown, which, as you can probably recite by now, is price inflation, debt debasement, and cash flow enhancement. You get to give the bank these dollars that melt in their hand. And in fact, even the tenant effectively gives these dollars to the bank for you because your debt is outsourced. What a deal. Well, earlier this year, Kristen Tate from Fox News was the first tax expert that we had on the show since the Biden inauguration 6 months ago. Things have since evolved, and we're about to get Tom Wheelwright's take and update on this. Hey, if you'd like to see the video version of Tom and I that you're about to hear next, check that out today on our YouTube channel. Maybe you want to do that after you listen here to the podcast version. That's a great way for you to reinforce your learning. People learn in different ways. To hear this in audio and then see us on video later can really help connect some dots for you. In fact, just in the last week, we've had a lot of content on our GRE YouTube channel that you're going to want to see, like where Chaley Ridge joins me on video to tell us about when 40-year mortgages are coming, and the best explanation that you will ever see in your life, because we're able to show you the numbers there on YouTube, from Chaley about how your debt-to-income ratio is affected when you add investment properties in your portfolio. But that video with Chaley won't be heard here on the podcast, only on YouTube. Just stacked anymore with great, valuable, free content over there. We are, I suppose, consistently branded. So find us over there on YouTube at a name that you are already very familiar with, because it's called Get Rich Education over there on YouTube. Let's talk to Tom Wheelwright. Today's guest is the author of the mega popular book, Tax-Free Wealth. He's the Rich Dad tax advisor. In fact, one of the companies that he founded has been doing my wife and I's personal taxes for more than 10 years now. He developed our tax strategy. And in fact, over a span of nearly 7 years now, this is his record 20th Get Rich Education appearance. Yes, he is indeed the most recurrent guest in show history. Welcome back to GRE, the one and only Tom Wheelwright.
Hey, thanks, Keith. Always good to be with you guys, and always good to be with your great audience.
Yeah, we need to have you back a lot because tax policy changes so much. Often it gets disrupted in a presidential administration or substantial changes in Congress, and that's certainly been no different this year. So what we're going to discuss today is the potential of raising income taxes, raising the capital gains tax rate, capping the 1031 exchange and the prospects for that, how to contest your property taxes, and then how you, the investor, can get a tax break by involving your children in your business. So, Tom, when it comes to raising the income tax rate, potentially a few years ago, the income tax rate on the highest earners was 39.6%. Trump brought that down to 37%, which I think was part of the 2017 Tax Cuts and Jobs Act. And now Biden has, I guess, threatened or stated the wish that he wants to raise that from 37%, which is where Trump lowered it to, back up to 39.6%. And of course, this is the federal rate only. So what are your thoughts on the prospects for raising the income tax rate?
First of all, a clarification. Biden not only wants to raise the 37% to 39.6, he wants to raise the 35% rate to 39.6. They tend not to say that in their commercials. They say, well, we're only raising rates on the top earners, but that is not correct. So people in that 35% bracket would go to 39.6. I actually think that is a highly likely change. I'd give it a 90% or better chance of passing, just like I would the corporate income tax going up to 25%. I'd give that a better than even chance of passing as well.
Yeah, and that's really interesting. Now, of course, this is something that affects essentially all earners in the United States. We're a real estate investing show. And when it comes to investments, we think about the capital gains tax. So regarding Biden wanting to increase where long-term capital gains tax rates are now, which is effectively 15 to 20% for most people, he wants to essentially double those up to about ordinary income tax rates. I think most people understand the income tax. That's the disappointing thing that you've been seeing on your pay stub from the time that you were 18 years old. But the capital gains tax, so we're talking about the profit from a sale of an investment that you've held for more than a year here. When we're talking about the long-term capital gains tax rate. So just the simplest example, and just to speak in generalities here, if we have a 200K property and it increases over time in value to 300K, we have a 100K gain, and that's the 15 to 20% that we currently need to pay tax on. And I think an important thing to remember is that an investor is only taxed when they sell. So, Tom, what are your thoughts with regard to Biden and Congress potentially increasing the capital gains tax rate from 15 to 20% up higher? Does that have a chance of going through?
Let's talk about what the actual proposal is. So it's only on people with taxable income of over $1 million. So that 200 to 300,000 is not going to have an impact unless you have other income that takes you up over the $1 million, according to their plan. The other thing that I think very few people are focused on is not only does he want to tax that when you sell it and increase the tax rate, he also wants to tax you when you put it into a partnership or take it out of a partnership. He wants to tax you when you put it into a trust or take it out of a trust. He wants to tax you when you transfer it to a child. He wants to tax you. He wants to also tax you when you die. All of those would be taxable transactions, which is a very big departure from historical tax policy. In fact, I think the biggest departure from historical tax policy since the income tax was enacted in 1913. I am hopeful that cooler minds prevail. This is a horrible, I don't usually take a position. This is a terrible idea. So here's what happens. If you look at what the Office of Management and Budget and even Biden's own people say, all of the tax foundation, all the think tanks say, if you don't tax capital gains at death, then taxing capital gains high during lifetime does not put any money into the coffers of the federal government. It actually decreases the amount of money that goes to the federal government. It would actually be a cost to the federal government because people will just hold it until they die. That's what it'll do. They'll buy, borrow, die, right? They'll borrow from it, and then they'll die, and the basis will go up. So these two are inextricably attached. The raise in the capital gains rate is inextricably attached to the capital gains at death. And the capital gains on a gift would be also tied there because if you could give it away without paying capital gains, why wouldn't you not give it away instead of waiting until you die? So any workarounds, here's the thing. Hopefully, saner minds will prevail. I think this is a horrible policy. I think it would be devastating to the economy. It'd certainly be devastating to real estate. What they could do is what they did in 2017 on the carried interest rule. And that is they could say it does not apply to real estate or business and only applies to pure capital gains like sales of stock. And if that were the case, I don't know, maybe okay. It certainly takes liquidity out of the market and it certainly doesn't add, of course. I don't think it adds a lot. I think it subtracts a lot. But at the same time, could they do that one? So a modified version of it, maybe, or a lower rate. They say that the maximum they could really raise it to would be 32% and maximize the revenues to the Treasury. So we'll see what kinds of exceptions they make and so forth. But the way it is proposed right now, I don't see a high likelihood of that passing.
It sounds like you see a greater likelihood of there being hikes to the income tax than you do the capital gains tax.
Yeah, it's an easier sell. It's pretty tough to argue against a 3% income tax raise on people who are making $700,000 a year. That's a tough sell. Really, who's going to argue against that? Capital gains, it's a little easier to justify if you're only talking about like stocks and bonds and things like that. It's a tough sell because, for example, let's say you own a home in California and it went up from 500,000 to 2 million just because of the market there and the low interest rates. Well, okay, now all of a sudden you're over $1 million. So guess what? You could kick in at that 40%, on top of which California is going to tax you at 13.3%.
Right.
So you're talking about a pretty high tax rate, over 50%. I hope that's not the case when it comes to real estate.
Yeah, and you're bringing up the fact that there is also a state capital gains tax in a lot of states. We've here been talking about the federal long-term capital gains tax rate. And yeah, you bring up some interesting points. I know that a lot of budget experts have done some research to show if capital gains tax rates get too high, well, then people just stop selling assets. And like we said, capital gains tax is only generated when you sell an asset. And when people stop selling assets, tax receipts to the IRS can actually fall. I've read that most budget experts think that the revenue that's best generated for the IRS seems to come in when the top rate is in the high 20s for long-term federal capital gains tax rates.
Yeah, typically not more than 32%. So that would mean a federal rate of, say, 28%, like you say, and then you got a state rate of 4 or 5%, right? So then you're at that top rate of 32, 33%. Now, if you want something really scary, Keith, there is a proposal by the chair of the Ways and Means Committee to tax unrealized capital gains at the end of every year. That's called a wealth tax. And there is a proposal. He is actually drafting legislation to do that. So if that passes, and you've ever thought of starting a business, start an appraisal business because there's going to be a high demand.
That's right. Now, I'm sure a lot of the listeners and viewers are thinking, wow, this capital gains tax is really serious. It almost sounds punitive in a way. I gave that example of the $200,000 to $300,000 property earlier, generating a $100,000 gain, at which one's currently taxed at 15 to 20%. You let us know about some of the caveats around that. Of course, there's something called the primary residence capital gains tax exemption, where your first $250K of a gain, single, or first $500K married is exempt from capital gains tax on a primary residence. And then, of course, as real estate investors, we have something called the 1031 like-kind exchange, also known as the 1031 tax-deferred exchange, where we never have to pay any capital gains tax if we structure things properly on our investment properties. In fact, I have legally never paid capital gains tax on an investment property in my entire life. Even as a 19-year real estate investor, Biden and the administration has shown some interest in capping the 1031 like-kind exchange at $500K, saying no more than $500K can be exempt. What are your thoughts on the cap on the 1031 tax-deferred exchange? Does that have a chance, Tom?
If the capital gains proposals go through, that one will go through. They're all tied together. They're all capital gains proposals. The challenge, of course, with that one is you take a lot of liquidity out of the real estate market and you have a real estate crash.
Yeah.
So that would absolutely create a real estate crash. So whether they're willing to do that, I don't know. It's a very low threshold. Some of these, you might just see a much higher threshold. So for example, you might see instead of a $500,000, a $5 million cap or something like that. So could you see it? Yeah, I think the 1031 exchange is in trouble. Remember, Donald Trump in his presidency in 2017 reduced the number of transactions that were allowable on a like-kind exchange. It used to be trade in your business car and do it in a like-kind exchange. Ranchers could exchange a herd of cattle for another herd of cattle, and that would be a like-kind exchange. And he unwound that or Congress unwound that really. So it'll be interesting to see what happens. I think 1031 exchange, I actually do think it's at risk.
That's really interesting that you think that, because I know previous presidential administrations had the same witches on capping or just removing the 1031 exchange. Why do you think it has a greater chance this time? Is it just because it's all tied together in this greater bundle that's getting more momentum?
I think so. And on top of that, there's all this crazy dialogue about you're evil if you're rich. And we need to close the wealth gap. Forget, bottom 80%, their incomes have risen faster than the top 20%. That's not important in today's discussion. What's important is that there's bigger gap in actual dollars, not in relative dollars between the poor and the rich. And a lot of that is simply because the government's been pumping so much money into the economy. If you can't get rich when the government pumps in $5 trillion into the economy in a year, I mean, seriously, what's wrong with us, right? If we can't get rich during a year like that.
That's right. Yeah, capping the 1031 as low as 500K, that would not incentivize people to sell. They'd want to hold on to typically larger assets like apartment buildings because it's easy to get a gain of greater than 500K. Therefore, that's the amount that would be subjected to the capital gains tax. So therefore, the way I see it, Tom, is, yeah, it sure would reduce liquidity on larger apartment buildings, but for those 1 to 4 unit properties,
it might increase. You're right. It might actually increase liquidity and increase the number of people who sell them. But remember, it's not $500,000 per transaction. It's $500,000 in capital gain that year. So if you had 4 transactions and they added up over 500,000, then I think you would still be subject to that additional tax.
That's a really important distinction. And again, a lot of budget experts have shown that capping the 1031 tax deferred exchange at only 500K wouldn't really raise a ton of money. Lawmakers might not see it as worthwhile as the massive fight that the real estate industry would surely put up over this. So then maybe it would be capped at a higher ceiling.
We can only hope.
Yeah, we can only hope that we continue to have this incredible benefit of the 1031 tax deferred exchange. Tom and I are going to come back and talk more about how do you contest your property taxes? What's your success rate if you contest your property taxes? And how can you involve your children in your real estate business and get tax breaks that way? You're listening to Get Rich Education. Our guest is Rich Dad Tax Advisor Tom Wheelwright. More when we come back. I'm your host, Keith Weinhold. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your eQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an eQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text eQRP in all capital letters to 72,000. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the #1 lender for beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com.
This is our Rich Dad, Poor Dad author, Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
You're listening to the show that's created more financial freedom for busy people just like you than nearly any show in the world. This is Get Rich Education. I'm your host, Keith Weinhold. We're talking with a familiar guest because he's Rich Dad Tax Advisor, Tom Wheelwright. You can learn more about him and how he can help you lower your tax burden to near zero at wealthability.com. Tom, as real estate investors, one of the substantial ongoing expenses that we have are property taxes. It's something that really I have not been up on lately. I have so many other things going on in my life. I sure haven't tried to reduce taxes on my own properties. Where are we at with the climate in America today, just in general, for how one can test their property taxes, and is it worth it?
I think it's absolutely worth it. There's 2 reasons that you would contest your property taxes. One is that your properties actually are being valued higher than the market. That's an unlikely reason. Another reason is that your property is being valued higher than another comparable property. That's something that happens all the time. Remember, the county assessor is the one valuing your property for property tax purposes. And county assessors don't always do their homework on comparable properties. So you might be able to argue. Let me give you a simple example. So I contested the property tax on my own residence many, many years ago. And you've got to be really careful. It had a basement of 1,000 square feet and then an upstairs of 2,300. So total, it was 3,300 square feet. Well, they valued it as if it was 3,300 square feet on a single level. Now, the reason for that is because the basement was less than half of the upstairs. Had the basement actually been 1,500 square feet, I would have gotten a lower valuation than the basement being 1,000 square feet because of how the rules work. So this is why when you challenge your property tax, you always hire a professional to do it. You never, ever do this on your own. Unless you've got a bunch of properties and you've got somebody in-house that is really good at it, you always hire an outside. And by the way, they'll do it on a contingent fee. So,
Great.
they'll just take a percentage of what the reduction is, and they're happy to do that. I have found that it's very common that you're going to be able to get that. Remember that property valuation is a bit of an art, and every state and every county has different rules on how that works. And so it's very important to have somebody who really understands the rules in your county and really understands them well and can make a good argument one-on-one with the county assessor.
Now, when it comes to an individual investor hiring that professional to help contest the property taxes for them, you said that that's a worthwhile thing to do. What are some of the things to look for when you want to vet that professional that you bring on to help lower your tax burden?
Just like anything else, you'd like to know their successes in the past, and you'd like to get an idea of how much they know about this. One of the best people to involve, by the way, is your CPA, because your CPA should have at least some experience and at least an idea of how to talk to that person. I think that CPAs are not used often enough when we're interviewing other team members, and that maybe involving your CPA in that interview might not be such a bad idea.
And Tom's surely going to have some great referrals for you on CPAs when you connect with Tom. Tom, are there any last things that someone should know about contesting their property taxes, how to easily identify when their property taxes are too high? You touched on some of that, but any other tips or help?
Certainly, I would, you could do an initial assessment and look at other properties that are similar to yours and see how they're being valued, because you should be valued the same. So it should be the same valuation per square foot, basically, if you're in a similar location. So it's not that hard because the county records are public. It really should not be that hard to do a search of comparable properties, which you're probably doing anyway for your, stay up on the competition. And then you can look at, okay, what's their valuation? Because that's public information compared to mine.
Tom, some people try to get their children involved in their business. That can help instill a work ethic in them, and it can give them some entrepreneurial experience. Tom, I had such an interesting question come in from Jane from Michigan. It's something that I would not have thought about before because I don't have children myself. But Jane from Michigan asked about tax planning for children, specifically real estate investors. She said, now let me know if I'm incorrect, but I've been looking for ways to minimize my tax impact by paying my son, Jack, as an employee. And she goes on to write, she thinks there are different rules for children under versus over 14 years old and a bunch of different requirements. But anyway, what she found out is that they can be a child model for real estate advertising and that there are advantages to doing this. She brought this up with some of her fellow mastermind group investors, and they all mentioned that they didn't learn about it soon enough and they missed out on years of tax savings when they were new investors. So what about this, using your child as a model for real estate somehow and getting a tax break?
So just consider that your child has a $12,000 standard deduction, just like you do, but only on earned income, which means you have to pay them for services. Understand also, if your child is under the age of 18, if you set it up properly, there are no Social Security taxes on those payments to your child, which tells you basically that the government is all for this. The government has said no Social Security taxes. And as long as it's a legitimate amount, legitimate deduction, and a real business expense, we will allow you to deduct at your high rate, and they'll basically be tax-free. On top of that, if they wanted to, they could even put it into a Roth IRA or a Roth 401k. So there's all sorts of tax advantages to including your children in your business. I grew up in a family business. My siblings all did. We all worked for my dad's business. I've got to believe that the tax benefits were part of it, but not the only thing. He wanted us all learning about the business, and we loved it. We actually all have fond memories of that. So I'm a big believer in that. I involve my children wherever I can. Now, the question of, can I involve them as a model? If you would otherwise hire a child to be a model, for example, let's say that you're talking about affordable family housing, then using your family as the model for that makes total sense. If you're actually promoting a seniors only community, maybe not so much, right? So remember, it has to be a legitimate business expense, has a business purpose, has to be ordinary and necessary, and you have to document it. But if you do, a good example would be a pediatric dentist. Would, them having child models, would that make all the sense in the world? Absolutely. If you're looking for your property, you want families, you're really going after families, then maybe having your children as models might make sense too. Just remember, needs to be a fair market rate of what you pay. You can't pay them $12,000 to do $500 worth of work.
Right. I can't imagine you could justify paying a child too much to feature them in some Instagram stories for affordable housing or something or other. So are there any other practical things to keep in mind about using your child in your business and getting a deduction that way, or just any other ways besides being the model that one can utilize children in their business?
Oh, for sure. I mean, think about this. If you have teenagers, they know way more about social media and marketing than you do. So have them do it. They will be better at it than you are. I had a client who his 8-year-old did his bookkeeping. And by the way, she was smart enough to do it, and she absolutely did it. So she learned bookkeeping at a very, very young age. You can have them, of course, do landscape work, mow the lawn, shovel the snow in your neck of the woods. Really anything that you would hire somebody else for, if you can hire your child to do it, why not do it?
That's a good point. Your 11-year-old might know TikTok hashtags better than you do. So yeah, have them manage your social media.
Exactly. And they might even do the postings. They can come up with, okay, here's what the TikTok people care about when it comes to real estate investing or property management or whatever it is. I actually think your children are a great resource. And in most states, and I don't know if this is true in all states, but I'm told by my attorney friends in most states that there are no child labor laws with respect to your own children. Now, there may be in some states. You want to check with an attorney on that. I'm not an attorney, but I do know that in many states, your own children are exempt from those child labor laws.
This actually brings up something interesting, because when we think about some of these, I guess, peripheral or niche strategies, a lot of times that brings up the question when someone is doing their taxes, I wonder what the audit climate is like today. Of course, we've had a change in presidential administration and a lot of other things in the last few years here. So speak to us about general overall, not just the children working in your business, but the overall audit climate at the IRS these days.
I'm going to mention two things. First of all, the IRS commissioner, Chuck Rettig, who is a former tax attorney himself, he was in private practice and he defended people against the IRS. He has been very aggressive in his audit. And you've probably noticed all of the discussion in the media about, the rich don't pay their fair share of taxes and they're cheating and so forth. What he wants to do, by the way, is not just go after the rich. He wants to go after everybody. And he wants $80 billion. And President Biden wants to give it to him to expand the number of auditors, to double the number of auditors. I think that they're being very, very aggressive right now. Now, here's the thing. All that means is you need to have a much better team than you've ever had in the past. We get an audit once in a while, not that often, but once in a while, and I'm never bothered by it. We have a client right now under audit. It's fine. I mean, we just deal with the auditor professionally, and we're very comfortable with it. One of the very first things you have to learn, though, is if you do get audited, you should never, ever speak to the IRS yourself. That is for your tax professional to do. They will not be emotional about it. They can be careful about it. They are professionals. Talking to the IRS for entrepreneur or investor is always, always, always a bad idea.
That's some great advice there. Tom, you've been helping people, we're talking about the audits, get all of the legal deductions that they possibly can, including ones that people often didn't know about, especially with helping entrepreneurs and real estate investors. You're great at giving just the right referral and customizing that just to what that individual investor needs, as to what their situation is, as to what their business type is, as to how much real estate they own, whether they have children or not, and so on. So if someone wants to get started, which they probably owe themselves to at least learn more about this, what is the best way for them to learn more, Tom?
So we have a network of 50 tax firms around the country, anywhere from people who handle people just starting out to people who handle the most complex situations. And that's actually why we started our Wealthability Network. But we also have a system that we apply to every single client to help them reduce their taxes. And it's that Wealthability system. It's not just the advisor. Remember, if you're going just to an advisor, you're getting whatever that advisor knows and nothing else. Whereas if you go to a system like the Wealthability system, now you're getting basically hundreds of years worth of knowledge with whoever your advisor is. And you know that they're going to follow the same principles that we follow in tax-free wealth. Anything we can do for you, it's just go to wealthability.com, as you mentioned, and we're really happy to help. And we're going to let you know if we think we can help. If we don't think we can help, we will let you know that too.
There aren't many guarantees in investing, but one of the near guarantees of you increasing your income is doing so by reducing your tax burden. Like I said, I have been using the Wealthability Network myself for more than 10 years, so it's been great chatting about this stuff, Tom. Check him out. Get started if you're interested at wealthability.com. Tom Wheelwright, it's been valuable as always. Thanks so much for coming back onto the show.
Great to be with you, Keith.
Some highlights from having Tom here. Under Biden, increases in income tax are more likely than with capital gains tax, but the 1031 exchange has a real chance of dying, in Tom's opinion. That's effectively a capital gains tax increase there. Stay tuned for that. And think about how that could create a flurry of property sales, as more people would want to sell their property and do their last 1031s before changes kick in. Hopefully that ceiling would be pretty high on where the capital gains tax exemption threshold would be. And understand how that would make the real estate agent market boom with tons of transactions if the 1031 died. And gosh, much like me, Tom feels more and more of this sentiment that you're somehow automatically evil if you're rich. Similar to last week's show about how I covered that landlords are often vilified in the media and elsewhere. I'll tell you what, if you have a friend that thinks that wealthy people are somehow evil, do this. Ask them 3 questions. Question 1 is, what amount of money do you think makes a person so wealthy that they're somehow now evil? Say that their answer is $20 million. Next question is, would you like someone to magically gift you $20 million? If they say no, they're probably not being truthful. If they say yes, then ask them, all right, now what is it about having that $20 million that makes you evil? I don't think they're going to have a good answer for that, because having more money just makes you more of who you already are. This week, Tom and I really talked about the bad side of Joe Biden and his administration's proposals and even threats to your wealth. Next week, Tom is coming back with me, and he's going to tell us about the good side of the Biden proposals and how you can use some of those to your advantage. Check out both of these complete video interviews with Tom and I on Get Rich Education YouTube. Until next week, I'm your host, Keith Weinhold. Don't quit your day job. Just kidding. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.